What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is October 21st of 2024. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I'm here today to do a major overview on Bitcoin and altcoins, as we are starting to see some of the most bullish price action we have seen in months. A complete changing of the relationship between moving averages and Bitcoin's price over the last 7 months. And along with that as well, we are starting to see signs that altcoins could be ready to pop off very soon. We're also going to be taking a look at the macro picture, doing a full 360-degree coverage. So if you guys happen to enjoy this video, consider dropping a like, grab a cup of coffee. You guys won't want to miss this one. All right, let's go ahead and kick things off here. So first up, I want to talk about this point of how Bitcoin and its relationship with the moving averages is starting to shift. And there's a lot of other things we're going to be diving into, but this one is really critical here because at the end of the day, price action is king. Price will tell you everything you need to know about how things are starting to shift here. And you can just see that over the past couple of months, whereas we were extended well above our 100-day pocket, the purple lines, and the blue lines, which are the 200-day moving averages, right? These are the 100-day moving averages. As we were riding up on the 21-day back here in Q1 up until March, we started to see a trend shift. Inconsistency at the 21-day, the yellow and green lines here. And then eventually we started making contact with the 100-day and then the 200-day, and we essentially started to treat those moving averages as resistance, spending more time below the moving averages than above them. This was again a clear sign of trend weakness here within Bitcoin's price. However, we have now reclaimed those moving averages. We were able to make both the 100-day and 200-day support back in early October, and since then we have gotten back above to the highest level we've had a daily close at since back in July. Well above our moving averages here. Now Bitcoin has a chance to be able to turn that 21-day yet again into a means of support. And if we can get that, if we really get a solid hold on that 21-day, perhaps on a pullback over the next few days, then that could really be our cue for Bitcoin to start shooting for the moon, to start really heading up here and getting some traction with its price. Now, there's another thing that I want to emphasize here, which is also coinciding with this optimism and price action. It's not just coming out of anywhere. It's obviously playing a part when it comes to the Bitcoin ETF inflows. So far, we're about 3 weeks in to the month of October, and we've got about 30,000 new Bitcoin being added in the Bitcoin ETFs in the United States. Again, we can look at the global numbers, but at the end of the day, it's mainly coming from the US markets. So US capital markets are really what we're going to be dependent on here for Bitcoin to accelerate. A 30K plus addition in new Bitcoin is pretty good. That's getting towards our target. As we've talked about before, we want to see months where we're getting 30, 40, 50,000 Bitcoin coming in here to these ETFs routinely. And last month, while the number wasn't exactly up in that target range, again, still at least positive months. We've gotten at least past the negative phase where GBTC outflows have been weighing down Bitcoin's price. But along with that, even some of the more kind of negative weeks where we had even some outflows in the Grayscale product, the BlackRock or IBIT, iShares ETF, as well as Fidelity and a couple others. So we even had some red months there, right, where we had outflows in a lot of those plays. So now it seems like we're back on the same page here. We're seeing thousands entering in each one, and that's coming up to about a 30K plus increase in the amount of spot Bitcoin in ETFs. But beyond that, we also see what's going on in altcoin markets. So we've got solid Bitcoin price action, we've got ETF inflows starting to turn up, and then finally, we've got others market cap here, really the bulk of the altcoin market here, excluding the top 10 largest coins, and really getting us into the mid and small cap plays. Finally, knocking on that 200-day, the upper part, the 200-day simple moving average. Guys, I just want to emphasize, I'm going to show you on the chart here what I mean. It is imperative to understand that once this 200-day is broken, there's a very good chance, and I'm not saying you can have a daily breakout, it might fade a bit, and we might want to make the 200-day support, or there might be a bit of chop. But once you usually see this break here, that is usually your cue that we're starting to move up, or we're setting the foundation for it to start breaking out. So for example here, we saw in July, a nice breakout above the 200-day, and from that point on, we made it support and eventually started to accelerate. Now you'll sometimes get these periods of time where it will take a while, right? From July to October, it was boring, and then it got interesting here for valuations, right? We can see here in the past as well that sometimes it moves a little bit quicker. We get above the 200-day like we did in 2020 from a $16 billion market cap rallying all the way to $417 billion. Now, I do not expect the multiples to be anything like they were in prior cycles. In fact, as we've talked about, I want you guys to really keep in mind here that you need to be a bit cunning. You need to be quick to take profits. Ride your winners, of course, but when you start seeing that 21-day not holding or those 4-hour EMA moving averages like the 9, 21, and 50 that we use for momentum, especially on meme coin trades, then slowly start to take profits and don't be sidelined holding and holding, hoping that it's going to go higher and expecting a 50x return. This is not about that. We are expecting that altcoins really over the next couple of months could come up to their prior high. They might go a little bit lower. They could go a bit higher within a general range of reason here, somewhere between a 50% acceleration, I would say probably like a 33% acceleration to 100% acceleration, doubling from where they are now. That is within a world of reason here because we've been there before in the prior cycle. We've yet to revisit those highs. And along with that as well, our relative high here was at 364 billion. So again, in percentage terms, that's really reasonable for altcoins as an entire market cap. And that's going to allow for a healthy amount of 2x, 3x moves against Bitcoin, not to mention Bitcoin will probably be expanding to some extent. And that's also going to possibly allow for a few 5 to 10x opportunities if you're in the right plays and the right narratives and there's that right influx. But it's very difficult to land those. So be cautious, make sure to take profits along the way. Don't get greedy. Don't have your eggs all in one basket and miss out on the move. Have a couple key plays and strong narratives that are showing solid price action. Another thing to keep in mind here is that others' dominance has not gotten above 10.5%. That's really my green light to let me know that like, hey, it's here and it's going to go on and it's probably going to go for a couple weeks. So we haven't gotten that yet, but we are making that 100-day support, which back then, the 100-day and 200-day were acting as resistance. So again, we're seeing that flip where maybe we can get above these moving averages like we did back here in July 2023 and start to really make it a means of support. And that's when dominance really started to accelerate. When you get above that 200-day, and the 21-day is generally going to be a base of support. At a minimum, you're going to spend more time above the 21-day moving average, right? So that's the key thing. But the 100-day is usually your friend there as a means of dip buying opportunities. And when I just take a look across the board here, the stronger fundamental plays, I take a look at Fetch, for example, which had a really strong rally off the lows in August, has had this nice pullback in percentage terms, run from 2,700 sats down here to 2,000, resting beautifully in that 100-day pocket. That's exactly what I want to see. It was prior resistance back here in the initial move. It was resistance back here. We're now making that support. And this is one of the strongest, I would say, medium risk, medium reward kind of plays we've talked about. We call basically acquiring, we basically on the Dash report, we sent out a recommendation to start buying this kind of around this range as we approach the 200 week. And along with that as well, just simply it was around similar percentage discount returns that we've seen within Fetch where it usually finds a bottom. Along with that as well, another fundamental kind of mid-cap, medium risk, medium reward play would be Fetch. Again, this one has been ranging sideways practically since back in June, albeit it did have lower points, but is basically where it was back here in May, still far below where it was back in March. So we've got a foundation here where even if we wait a little while until this gets above 3,000 sats and really gets a close above that 200-day, that's going to be my cue to get really excited. Just bringing it back here to Fetch. If you want to be more conservative, you can wait until that break on the 200-day. But I think overall this is decent for an entry here. You just have to have some stop set in mind. Don't put it too close because you'll get stop hunted. It's really important to understand that here. You're already buying at a nice discount here. Give it some wiggle room. Let it do its thing. And at that case, you're going to have a really solid play that I think could easily be a 2-3x return opportunity in an altcoin cycle versus some minimal downside if your stop loss gets hit. I wanted to talk about the large cap plays as well because while we've got our more kind of mid cap altcoins we're watching that are showing strength, we also have some positive signs of Bitcoin and Ethereum. I don't expect anything crazy or incredibly positive with Ethereum, but I think we could see Ethereum coming back here and testing the 100-month EMA, and that's going to get people excited enough because it's going to bring us back to where we were back in May or in August. Maybe it goes a little bit higher, but this isn't exactly what I'm looking to trade. More than anything, I'm liking that, whereas this was expecting to break down here at the prior lows, it seems so far that it's holding here for over a month now. and we're back above the 21 day. So hopefully there's a chance for Ethereum to accelerate. That will have positive trickle effects on a whole range of different altcoins, from Bitcoin down to Ethereum, down to the various alts that we're looking to trade. Solana as well. While I do not recommend that you go long Solana and don't hodl in DCA on Solana personally, I don't believe that that's the route to take. I'm not really extremely excited about it on a trade perspective. I do believe it can come up back here to the prior relative resistance range, and on a more optimistic altcoin cycle, maybe come up here to do a little less than a double here against Bitcoin, its valuation. That is really on the optimistic tail end in my view. So again, Solana is not really my play here, but what I like seeing is that we're at a minimum at our highest level since back in August. So cutting back a couple months of just sideways or downward price action, and we're finally above our moving averages. There's a chance here where Solana can finally start to take off again. I wanted to go ahead and talk though about meme coins, because this past month in the Dash report we had sent out a couple of different picks, some of them that we mentioned here in this channel. I try not to completely close off everything just for the newsletter subscribers, although it's a great way for you guys to support the channel. But one of the picks that we put out there in the newsletter was watching for MOG, for example. This is one of the big meme coins that's entered towards the $1 billion market cap club for meme coins. This is a long-term kind of OG meme coin. This is already well trading back here in 2023. But the main thing I wanted to emphasize is that MOG we recommended on a pullback to the 21 day. Watching for this to pull back a decent amount. Nice, decent pullback. Good entry here versus just buying it straight into the trend. And since then, it's up over 80%. This is one of our few picks we had for the month in the newsletter. And these are the kind of picks that we like to share with you guys that we're looking for, that are showing common things that we chat about here in this channel. Exhibiting strength. They're showcasing strength in the trend. They're one of the strongest players when it came to the rebound off of the lows back between August and September. When they finally started to rebound, they started to show those signs of optimism. And at the end of the day, it's in one of the strong narratives, meme coins. This is going to be, without a doubt, guys, one of the top narratives going into the close of this cycle. I don't expect, if there is going to be an altcoin cycle, if there's going to be an upcoming higher Bitcoin level than the one we saw back in March with the increase in ETF inflows and maybe some renewed optimism, I would bet money that meme coins are probably going to be one of those narratives that really just provides those crazy returns. It doesn't mean that you should hold them or that you should believe in them like other altcoin projects, let alone I don't feel you should do that with any crypto project nowadays. You got to be a little bit cynical and a little bit smart and apply street smarts and take profits along the way, not get too greedy, keep yourself in check. And I promise you, like, there's a good chance that you can make some returns in this market. There's no guarantee, but there's a pretty good chance if you can nail the right narratives, you watch which plays are showcasing strength, because those tend to be the things that are going to keep giving you those returns as the market gets more and more confident. If you guys want to join the Dash report, you can check out the link down below in the description. It's definitely going to be an exciting time over these next few months, so it could be valuable for you guys to check it out. And you always get a 20% discount if you sign up with a yearly membership. Even beyond crypto, once crypto fizzles down and we go through a potential altcoin cycle and re-acceleration of Bitcoin, there are other market opportunities out there, and you got to be prepared for those. So I definitely recommend you guys consider the dashboard, because we cover things from a 360-degree perspective. We cover crypto, stocks, commodities, and Forex markets. And you get a whole range of different benefits here when you join with the Dash report. So feel free to check out the link down below in the description. Again, even if you just want to support the channel, it's a great way. It's less than $1 a day. So it's a great way to support all the free content we put out, plus getting some really great insights from both myself and Russ. Now, I wanted to go ahead and talk a little bit, though, about one of our partner projects here in the channel, which is Zero, because there was something really exciting that got released towards the end of last week, and I wanted to give it some time to talk about it here so you guys don't miss it. Now, obviously, there are lots of different L1 protocols out there in the crypto space, but one of the big narratives that I think is going to be huge as we talk about the institutionalization of crypto, and ideally seeing, DePIN, seeing Web3, other Web3 narratives like DeFi come back into play from an institutional implementation, really getting large sums of capital and enterprise companies into the space. One of the big things I think is going to be a huge narrative is privacy. And Zero just recently released the shielding demo on the zkOS on testnet. Now, I want to talk about why this is a really big deal. It sounds a bit technical, but to explain it in simple terms, Al0 has demonstrated on testnet the first real practical implementation of privacy-based transactions on an L1 protocol that I've seen in such a simple and clear way, using zero knowledge to be able to shield transactions. Now, there's a couple different details that they write about here within the article or the blog post that they have on their website, but the cool thing about it is that you can go ahead and try it now in testnet. It's available on the Common Shielding demo. This is one of the big projects on the platform. It's one of the large AMM protocols, but I'm assuming they're going to also add other features down the line. Common is one of the most critical applications on Al0's testnet. And the big thing above all I recommend you do is you can try it out yourself if you want to see it. The magic is really cool to see it, how it plays out. But essentially, what this is doing here, if you watch through the demo, it allows you to essentially see how you can essentially put funds into a almost effective private pool using zero knowledge proofs that essentially, without exposing who you are, not even your on-chain address, your 0x address, right? You're able to essentially put funds into a pool and then from there be able to send it to various different parties. You can send various amounts, you could do it in multiple payments, and essentially there is a key or password that you're going to have attached to your wallet that will allow you to reclaim those funds, either if you've deposited funds into the pool, or essentially if you've received pooled funds that are shielded, you'll be able to claim those funds. And it's all done on the local client side. So this is done locally on your device, whether you're on a mobile phone, whether you're on a computer. It's a really cool thing, and it's in sub-0 seconds. So essentially, sometimes you can do this in a fraction of a second to a second or two. It's incredibly lightning fast. So from a user experience perspective, this is critical, not just for many end users in crypto, but it also is very valuable when you're talking about enterprise clients who need to be compliant to, say, GDPR in Europe, where their users' funds and also their privacy and data as a whole needs to be respected. And beyond that as well, it just overall opens up really a whole world of explosive opportunity for enterprise applications beyond even DeFi and enterprise DeFi. So definitely watch this demo. It's very exciting stuff. And again, if you guys did miss it in the prior videos, it's okay, but I want to let you know that Al0's mainnet update recently came out, and this is implementing the token supply metrics that were recently voted on in the governance process. So this is really critical updates that you guys shouldn't be missing on. I definitely recommend you just read through the recent blog posts and keep an eye on A0 as a token. I think it's one you guys are going to want to watch over the next couple months as this has started to range rather than downtrend. So just keep an eye on it over the next couple of months. It's one of the strongest fundamental plays out there alongside Radix, alongside some of the other protocols that we've talked about from an L1 perspective. We're really happy to be working with them. I've been following Al0 since back in late 2022, so it's coming up on over 2 years here, and the team has been doing phenomenal work. Now, I want to go ahead here and get to the big picture. I want to talk about what's going on in equity markets here, guys, because as markets have continued to accelerate here over the past few months, the last quarter was a really phenomenal period of time. The S&P 500 accelerated another 5.5%. The NASDAQ also doing quite well during that period of time. All broad indices doing pretty well during that period of time. It is time we really keep an eye on equities, guys, because I know I've beaten it like a dead horse. I know some of you guys are probably getting tired of me talking about it, but give or take this line here, this 95-year channel we've been in, and the S&P 500 between exacerbated lows and highs, we are pressing up against the line that is defined by two of the past prior euphoric periods, the dot-com bubble and the late 90s into 2000, and the roaring 20s in 1929. So we're really talking about a channel which has been at play, a line of resistance, if you will, that has been in play from these two significant highs for over 95 years. And we are pressing right up against it. This, to me, is a really big inflection moment. We actually wrote about this in the Dash Report, I think it was 2 months ago back for the September newsletter. And I want to echo how important this is going to be in determining the next couple of years. Are we going to see a dot-com bubble experience similar to that of the 1990s, where all companies, I think it's not just going to be NVIDIA. NVIDIA would probably be the leader here. It is one of the AI plays. But considering the size and scope of NVIDIA, what I think you might start seeing is in percentage returns, you're going to see the trickle-down positive effects of essentially being able to automate a lot of routine processes across a variety of companies. So there's going to be a secondary benefit where if NVIDIA is able to continue charting forward as a market leader and continues market cap appreciation, that's not only going to boost the indices like the S&P 500 and the NASDAQ, but along with that as well, it's going to help all companies who can further automate processes and essentially cut down on labor costs, right? This is, again, going to have huge ramifications, like for a broader kind of macro discussion about what's that going to mean for the world. But as a purely like trader perspective here and a valuation perspective for companies, this could really start to allow companies to trade at much higher valuations if AI acceleration continues, or at least at a minimum if the market continues to price it in and there's nothing that really essentially shoots the trend in the foot. And that will mean that if we really get up to about 6,000 points, which is well above the logarithmic target, I did some calculations. It's either between 59, I think around 5,900 points to 5,950, which we're really getting close to here. So if we get a continued acceleration here, that can mean that we're entering into a bull trend for the next year or two where things could continue accelerating. However, I'm not here to speak in absolutes, and even in the newsletter article we talked about, right? I'm going to wait and see. Like, we want to see some price action to really get that feeling. And we're still going to also use, say, the 21-day and the 100 days kind of gauges to be able to protect ourselves in case it does, if we were to go long and it doesn't work out that way. But along that as well, this line is held for 95 years. And I usually heed on the side of caution there because while I do believe that there's exciting technologies, I think that AI-related productivity is definitely going to be helpful in some industries. It certainly has disrupted software, right? So that could allow a lot of tech companies that were previously not profitable to be able to cut back on labor and be able to start becoming profitable again, and starting to really accelerate beyond where they already are at the moment. There are those opportunities, but there also is the opportunity for equities to get slammed down here, as we saw back during, not only when we didn't retest it here, like back during, for example, in January 2022, when we started to break through the moving averages, but along that as well, if we go throughout history, just go ahead and get the chart adjusted here. We go all the way back to the dot-com bubble, right? We had a significant rally into the line, right? Of course, this is, again, formulated by that high the prior. So, again, I just want you to keep in mind what kind of price action to look for here, right? A retest of those moving averages, and inability to continue accelerating along that line. That's your cue to be like, okay, whoa, got to be careful here. Slowly but steadily, day by day, cut the risk out, go back into cash, and wait for a clear trend, right? So that's the big thing here. Watch this line, guys. It is incredibly significant from a long-term trend perspective. This is the big picture here, guys. And while I really think that, AI does have this chance to do really big things for the world, at the same time, you never know if it's being oversold. You never know, when I say oversold, in its promises at the end of the day, right? You never know if markets can be too overbought in the short term. It might still be over the next couple of years that AI allows for it to break through this upward line of resistance. But again, at the end of the day, keep in mind some of the most important valuation models and what some of the big boys are doing. It was a couple months ago that Stanley Druckenmiller and a couple other large investors started selling NVIDIA. You've got Buffett, who has his largest cash position in years. In net terms, of course, he's got his largest cash position ever because Berkshire Hathaway's gotten bigger and bigger. But in percentage terms, it's very noticeable versus what it used to be. And if you look at the Buffett indicator, which is the U.S. stock market, total valuation of the market, in this case versus GDP, you're seeing very clearly here that we are on the 2 standard deviation line here, which is similar to where we were back during the dot-com bubble, here in the 1960s, before we entered into a downtrend in the 80s, and along with that as well here in 2021. Right, and this was the August figure, right? So I would bet, again, that you sometimes get a little bit of discrepancy in the data here. The Wilshire 5000, which is what's used for the ratio here on this long-term trends chart, says that we're at 200%. But again, even comparative to where we were during the COVID bubble and the peak of November 2021, we are trading at a premium here. And I understand that AI is now part of the picture, but you have to understand here that this discrepancy going from 145% to 193% was that stimulus effect, the excess money in the system that allowed for premiums and valuations to trade so high. So as a comparison of the dot-com bubble, which was 132%, We're now at around 200%. And I want to make it very clear that over time, I do expect this to move in an upward line. You can see here on the Buffett indicator, the standard deviation across the historic trend line is that it's generally going higher here. And that makes sense as things consolidate and as there's excess money in the system and people don't know where to park that money, so they park it in markets, right? The world is becoming wealthier and wealthier, and that's a great thing. But it doesn't mean that there can't be short-term discrepancies that last upwards of many years to a decade. This has happened many times before, and we may be on the tail end of this cycle. So keep that in mind. You can also look at the value of public and private equities to GDP ratio, right? So this is also taking in private equities as well. Not as high as where we were back in April, considering that, but still relatively on the higher end here and much higher than where we were back here in the dot-com bubble or here in 2008. So just keep that in mind as you go through all the different types of metrics. The Dow, which is definitely not the market leader anymore, this is industrial, still trading at its highest PE multiple, going all the way back here to the 1940s. So it's a long period of time that we haven't been in this kind of range here. And this is one of your more kind of long-term metrics of health on the market and discounts, finding corrective periods of time to buy stocks versus GDP. There are a lot of really cool ratios like this, the S&P 500 against there, and you can find all kinds of really interesting data points. But above all, guys, I'm going to let you know what really matters most here. What matters most at the end of the day is just focusing on whether or not NVIDIA is continuing to charter forward. NVIDIA's weekly setup here looks good. And so long as that continues, it is going to mean a broader repricing in the overall equity markets to the upside for stocks to be able to cut back on costs and be able to benefit from the increased productivity and cost savings of AI, allowing prior business models that might have not been profitable to become profitable and start trading at much higher PE multiples with further up projections. So this is an important critical thing to keep in mind here, guys. Again, I don't know when that level will be for NVIDIA, but so far it looks like it's got a solid trend formation here, and we didn't even come down to the 200-day, right? So versus that, let's say for example, the prior pullback here before NVIDIA really continued into a bear market here into 2022 from $34 down to 10. This time around, we didn't even come to the 200-day, and we had a higher low here, and we're right back to the prior highs here. And that's even with Jensen Huang, who's the CEO, conducting insider selling. You've got, again, right now, tech is still remaining strong here. It's not where I'd want to be exposed. I think that other sectors are going to start to outpace that. A great example of this is we can see SMH as a broader industry. The semiconductor ETF still hasn't reached its prior highs. And what I think is very important is if you take a look at the NASDAQ to Russell 2000 ratio, which is the tech stocks index against the small caps. What we're seeing here is a relative top here in July and a huge rebalancing that happened here behind the curtains that a lot of people didn't really pick up on. But I think Russ has also chatted a bit about as well. Again, this is where we're really aligned to markets. I think above all, watching these shifts and these reallocations and capital inflows and outflows from various parts of the market, you're going to start to see early warning signs here. And this is, I think, one of those signs that, NVIDIA and all these technology companies have traded a huge premium because they're the direct line of exposure to the growth in AI because they're service providers, they're purchasing these chips, using capital expenditures to go out and purchase all of NVIDIA's products and be the leader in AI and train models. But now, I think markets are starting to realize that even if that scenario plays out, if generative AI continues to grow bigger and bigger and be useful in more things and get more accurate and more humanized and closer to AGI, which is artificial general intelligence, which we really haven't seen, if that plays out, that's going to have huge benefits, as there's essentially, it's a cost war. All these companies are trying to do the exact same thing, and they're going to have to outcompete on scalable cost to run these systems. And that is going to, if it plays out, be at a net benefit for the majority of small and mid-cap companies who will utilize these services. So again, it's not that the big tech companies won't benefit from it, but just to keep in mind there that is a valuable element here that is something to keep in mind. And we watch the price action, the ratios, and this basically showcases that tech stocks against the Russell 2000 topped at a 9 ratio here back in July. I shot down here in the month of August to 7.6, and so far those long-term moving averages have been acting as resistance, which likely means we're moving lower, which means that the Russell 2000 will likely start to outpace the broader tech stocks. Now that can mean two things. It could mean that all stocks are moving lower and that tech stocks are just going to get hit harder because the AI narrative is fading, or it could mean that we continue in an uptrend and the small caps take over like we saw between August of 2020 here to March of 2021. That was a period where small caps significantly outweighed the tech stocks, right? And of course that could ebb and flow, or big tech starts to take back the lead, or when we have a pullback, essentially the small caps bleed even heavier. So that's an important thing to keep in mind here. The Russell 2000 as well is again picking up here, looking like it's ready for the next spring up here. Beautiful technical formation. I'm looking forward to this having its full breakout. And we've got a lot of market leader sectors that we've been writing about in the Dash report that are not in the crypto sector, and we haven't really gotten to chat about here, that I definitely recommend you guys, if you haven't already, consider subscribing even for a couple months, just so you get a digestion of what kind of things we're watching for in the market, because there are going to be a lot of opportunities for the next decade that are not going to be in crypto, and I do genuinely believe are going to outpace Bitcoin. When you get particular with the narratives, particular stocks, you're going to do quite well. And another thing as well, on the optimistic tail end, is that oil is continuing to trend below the 100-month here. Now that again usually would signal kind of like recessionary pressures, but what I think in this case, at least in the short term, we need to consider is that this short-term, near-term decline below the 100-month is usually followed by multiple months of follow-through and a significant decline in oil's price, historically speaking, right? Now again, what that means over the next, say, full year or two, I don't know about that, but in the short term, that can provide some ample support for equities as well in the fight against inflation and lead the Fed to not have to hold rates as high as long as they previously were expecting. So keep that in mind here. Oil is a huge component of the cost of inflation. But above all, we come back here towards the close, guys. I want to emphasize that again, when it comes to Bitcoin, when it comes to altcoins, we're on the cusp of being able to start making some serious bets in the market as those signs of optimism are finally starting to return. And outside of that as well, when it comes to the macro, we have to make sure, even though we have some opportunities here in the near term in crypto, that we are a bit more cautious until we get further follow through in equities. Because at the end of the day, until we get some solid price action established above that historic line of resistance between two of the prior significant highs, the dot-com bubble and the roaring 20s, until we get that, we need to be cautious and be eager to take profits, because we are on what appears to be on the risky tail end of markets. The valuation premium in equities is high. Crypto, for the level of adoption there really is right now, is trading at very high valuations. And even though we haven't seen some euphoric bull market to 200K or 500K for Bitcoin, it doesn't mean that by any means we are guaranteed that. And if we consider diminishing returns from cycle top to cycle top, or cycle bottom to cycle top from each cycle, you will realize that the valuation returns that we can expect this time around are probably no more than a price tag of $90,000 for Bitcoin. That's our target for this cycle. The closer we get to that, the more eager I am to take profits, especially if we start to see established trend weakness. And so many will probably be seeking out some big even level like 100K or 200K. And again, if we see a very easy clear through that number and confidence remains and the 21-day is still our friend, then we probably won't fight the trend. We'll keep going with it. But you got to lean into those moving averages. You got to know when things are getting euphoric, and you can't get sidetracked by what everyone else is telling you, that you got to be euphoric and you got to be taking excess risk because the money print to go burr. Well, sometimes the market also goes down 50%. Much more important to avoid that than maybe some slight depreciation of your money over a year or two due to inflation. Trust me. The market can very well rob you of your wealth just as quick as inflation. So that's it for today's video, guys. I rambled on a good amount here today. If you enjoyed this video, consider dropping a like. Make sure if you have some time to check out the shielding demo on Zero. Get a feeling for the network. I think it's really cool. They have some really great technology. And outside of that as well, Zero is really going to be one of the leaders in privacy, in my opinion, over the next couple years. So it's definitely an L1 to keep on your radar. And of course, as always, you guys can check out the dashboard if you'd like. But above all, if you enjoyed the video, consider dropping a like. It's a great way to support the free content we put out on this channel. And until the next one, I'll see you guys next Monday. Take care, everyone.